Hello to our viewers. I'm Jen Kohls of Richardson Capital Management, and I'm joined with Dan Brown, our Director of Investment Management. We're here to provide an economic and investment update for May 2025. The themes of volatility and uncertainty continue during the month of May, but with a better outcome for equities. Dan, what would you say was the catalyst for the rebound in the stock market?
Yeah, the primary catalyst was the fact that the tariff tensions receded during the month of May. So after three consecutive months of losses from the stock market, February, March, and April, we saw the volatility continue into May, but this time to the upside.
Mhm.
So the primary catalyst was the fact that we reached a temporary truce with China on tariffs. So in the middle of the month, the Trump administration agreed to reduce the tariffs on China imports from 145% down to 30%. And then later in the month, we saw also the tariffs get pushed out with the European Union. So those tariffs are going to be negotiated, and hopefully they'll come to an agreement by that deadline in July. So we saw a pretty meaningful rebound in the stock market the past month or so. So about a 20% rebound from the April lows to the middle of May.
Last month, we talked about the unsustainable level of federal spending, and this remains a hot topic. Dan, how has this evolved over the past month?
So in the month of May, we saw the House pass a budget bill that is now going to be debated within the Senate. And the two topics of the debt and the deficit are very closely intertwined. So first of all, with the bill that is going to be debated in the Senate, now we don't think it'll last. We think there's going to be some fairly meaningful changes, as there's been a number of very prominent Republican senators that have voiced concern with how much deficit spending there still is in that current House bill. And just to look at the tie between deficits and debt, the graph that we're showing here is looking at the long-term trajectory of the outstanding amount of federal debt. So going back to 1980 through current day, and just to break that down into three different time periods, that first period from 1980 through 2007, we see outstanding federal debt growing at a fairly modest pace, perfectly sustainable. And then from 2007 through 2020. So we had the great financial crisis in 2008, 2009. The US government responded with massive amounts of fiscal policy response. And then during COVID of 2020, we see a fairly meaningful spike up in that graph, and that pace of issuing debt to support deficit spending has continued.
We also experienced a significant event on the fixed income side of the markets. Dan, would you like to share some color on that topic?
Sure. So we saw a credit rating downgrade for US government debt during the month of May. And a lot of that ties back into the last comment that I made about the amount of fiscal spending that's being supported by the US government issuing more debt being unsustainable and unnerving investors. So it not only is unnerved investors, but it's also unnerved some credit rating agencies. So again, we saw a downgrade from the highest level of creditworthiness in the month of May. But this shouldn't be too much of a surprise because, again, we've known for a while that the amount of debt has been growing, the deficit spending has been growing, investors are becoming concerned. And we've also seen credit rating agencies going back initially to 2011, post the great financial crisis, and more recently in 2023. So this just confirms sort of what we already knew, but it did cause a minor spike in interest rates around mid-month, as basically investors are saying they want to be compensated with a higher interest rate for a slightly higher level of debt outstanding.
With all that in mind, what is our outlook?
So we still think that the environment's going to be volatile because we're still going to be dealing with some trade uncertainty and tariffs for the next couple months. But as we sit back and look at the economy, financial markets, corporate earnings, we still think there's more positives than negatives. So we just wrapped up first quarter earnings season, and US companies beat on both revenues and earnings. We think this will continue through the remainder of the year, and it could be supported by stock buybacks, which we think is a pretty powerful theme. And we encouraged by the fact that a lot of the information technology themes are reasserting themselves after taking a break in the first quarter. So again, we still think there's more positives than the negatives, but volatility probably through the summer. And more recently with this budget bill that'll be debated, we think eventually something will be passed and the tax cuts from the 2017 Tax Cut and Jobs Act will be extended.
Thank you for sharing your insights, Dan, and thank you for watching. We appreciate your trust and support.